Friends, welcome to this interesting video on the concept of contribution and how this idea actually helps us in presenting the statement of profit and loss in a very different way, which in turn helps us in getting many insights. I'm just going to touch upon those insights here in this video, but I have detailed videos on those topics, so please explore them as well. Welcome to the video. I'm sure you must be already aware about the concepts of variable cost and fixed costs. I also have videos on those subjects, and I'm sure you may like to explore them. Briefly, fixed costs are those which are linked with capacity creation, and they are typically paid for by time. Example is salaries. Most part of the salary gets paid by time every month. There is a variable part which is like the incentive or bonus or a variable pay, which depends on performance. But there is a certain large component of the salary which gets paid irrespective of whether there is production, sales, performance of the company. And those costs are linked with time, and they are called as fixed costs. Variable costs, on the other hand, are those which are typically paid for based on their consumption rather than for time. They form input into a product, which we can trace to a product generally. Their examples include raw materials, packing materials, energy, which you can trace to products, and therefore their total cost of raw materials, packing materials, etc. will vary in tandem with the production and sales of those products. Now, contribution on a per unit basis is an idea which is derived using selling price and variable cost. Contribution can also be derived for a segment, on a per unit basis, for the whole product group, or even for the company. It provides some very interesting insights for managerial decision making, including capacity allocation decisions. For example, you can compare the contribution of a product group with the capacity that it blocks, and by doing that comparison you can find out which product group generates more contribution for every unit of capacity, and then you should ensure that the capacity is allocated in favor of those products which generate superior contribution. Now, why do we use this unique word contribution? What is it contributing to? There are two layers of fixed costs in any organization. One layer of fixed costs is called as operating fixed costs. Those which are incurred in the operations of the company. They include salary, various other fixed costs which are paid for by time. They include depreciation, rent, property taxes, certain amount of travel which has to be undertaken for the business of the company. All those are fixed costs. And operating fixed costs, to be specific. Then there is another layer of fixed costs which is called as financial fixed costs, and that is on account of the interest which is mandatorily required to be compensated to people who have lent money to us. So that is the financial fixed costs. Now, once all the fixed costs are contributed to by the contribution and are recovered, such as salaries, rent, electricity, and so on and so forth, this contribution straight starts contributing to the profits of the organization. And thus, once you cross the concept of break-even point, about which again I have created a separate video, contribution straight away starts contributing to profit beyond the break-even point. So do explore that detailed video on break-even point. Now, this contribution divided by sales price gives us contribution margin. So for example, let us say that a company has sales of 1000 crores, variable costs of 400 crores, then the contribution pool is 600 crores. This 600 crores divided by 1000 crores gives us the contribution margin. Now, once this contribution margin as a percentage is derived 60%, it can also help us in deriving many other concepts. Also, interestingly, the statement of profit and loss, which is published by every company as a part of its annual report can also be reorganized as contribution income statement using this idea of contribution. So sales less variable costs gives us contribution, as we have discussed. Contribution starts contributing to recovery of operating fixed costs. Once those are recovered, then we have profit before financial fixed costs. Then it starts contributing to recovery of financial fixed costs. And then once those are recovered, we have profit before tax. Now sales and profit before tax in both those statements is going to be exactly the same. All that we have done is we have reorganized the data in the middle with a view to seek more insights on different ideas, which include ideas such as break-even point, margin of safety, operating leverage, financial leverage. And I have already created videos on those themes, and I request you to explore them as well. But they provide us some very interesting insights and help us in taking the right managerial decisions. Thank you for watching this video. Do share it with others.